Something changed in pension tax law on the 29th of June 2026. It did not make the news. It did not arrive with a press release. But if you are approaching retirement, drawing benefits from more than one pension, or planning to take a tax-free lump sum from a pension you have been building for decades, it changes the calculation. And the people it affects most are precisely the people least likely to have been told about it. Before I go any further, I want to address the two reasons you might already be thinking about leaving. If you completed your retirement planning years ago and consider your pension arrangement settled, you may think a change in how HMRC orders lump sum events has nothing to do with you. And if you have never had more than one pension in payment at the same time, you may think the ordering question simply does not arise. In this case, both of those instincts lead you away from something that may matter. So stay with me for the next 20 minutes. Because the fix that came into force on the 29th of June is a correction to something that was broken from the moment the old lifetime allowance was abolished in April 2024, and 2 years of people retiring under the new system means there are real amounts of tax at stake for real people. If this kind of plain English breakdown of what is genuinely changing in UK pension rules is useful to you, subscribe now. It costs you nothing, and it is the only way this channel reaches you the next time something shifts. To understand what changed on the 29th of June, you need to understand what replaced the lifetime allowance when it was abolished 2 years ago. The lifetime allowance was the total cap on pension savings that could be taken without an extra tax charge. It stood at £1,073,100 until it was abolished from the 6th of April 2024 by the Finance Act 2024. In its place, 2 new allowances now control how much tax-free cash you can receive from your pensions. The first is the lump sum allowance. This caps the total amount you can receive as tax-free cash during your lifetime, across all your pension schemes combined. The standard figure is £268,275, though it may be higher if you hold one of the lifetime allowance protections: fixed protection, individual protection, enhanced protection, or primary protection that were available under the old regime. The second is the lump sum and death benefit allowance. This is a broader cap of £1,073,100 that applies to certain tax-free lump sums paid both during your lifetime and on your death before age 75. Both allowances work on the same principle. Every time you take a qualifying lump sum, whether a pension commencement lump sum, which is the standard tax-free cash paid when you crystallize pension benefits, or an uncrystallized funds pension lump sum, which is a way of taking money directly from a pension pot, it is tested against your remaining allowances. The technical name for each of these events is a relevant benefit crystallization event, an RBCE as they are known. And here is where the problem that was fixed on the 29th of June lived. When the new regime came in on the 6th of April 2024, the rules already allowed individuals to choose the order in which multiple RBCEs were treated as occurring when more than one happened on the same day, but only for the lump sum and death benefit allowance. The ordering choice existed for the LSDBA from the start. It did not exist in statute for the lump sum allowance. That was an asymmetry, and an asymmetry in the ordering rules between the two allowances created a genuine practical problem for anyone crystallizing benefits from multiple pension schemes on the same day. Here is why the ordering question matters. The lump sum allowance of £268,275 is the cap on total tax-free cash in your lifetime. If you are drawing benefits from 2 pension schemes simultaneously, each of which involves a pension commencement lump sum, both of those lump sums count as RBCEs against your lump sum allowance. The order in which they are tested determines how much of the allowance each one consumes, and therefore how much of the second or third lump sum can still be paid tax-free. For someone crystallizing benefits from a defined benefit scheme and a personal pension on the same day, being able to choose which RBCE is treated as occurring first can make a meaningful difference to how much of the second payment falls within the tax-free limit and how much tips over into income tax. Under the original 2024 legislation, that choice did not formally exist in statute for the lump sum allowance, even though it did for the lump sum and death benefit allowance. The regulations laid before Parliament and coming into force on the 29th of June 2026, formally titled the Pensions, Abolition of Lifetime Allowance Charge, etc., Regulations 2026, correct that gap. The amendment inserts the ordering choice into the lump sum allowance rules, aligning them with the rules that already existed for the LSDBA, and the correction takes effect not just from the 29th of June 2026. Most of the amendments in these regulations take effect retrospectively from the 6th of April 2024, the date the LTA was abolished. Let me give you a person to place this alongside. David is 63. He worked for a manufacturing company for 22 years and built up a defined benefit pension there. He also has a personal pension, a SIPP, that he has been contributing to since the mid-90s. He has no lifetime allowance protections. His standard lump sum allowance is £268,275. He decides to crystallize both pensions on the same day. His defined benefit scheme pays a pension commencement lump sum of £210,000. His SIPP crystallization also involves a pension commencement lump sum in the standard 25% of the fund value, which comes to £80,000. The combined total of the two lump sums is £290,000. That is £21,725 over the lump sum allowance. The question of which RBCE is treated as occurring first determines where the tax charge falls. If the DB scheme's lump sum is tested first, it consumes £210,000 of the allowance. The SIPP lump sum is then tested against the remaining £58,275. The £21,725 above that is taxed as income at David's marginal rate. If David instead chooses to have the SIPP lump sum tested first, it consumes £80,000 of the allowance. The DB lump sum is then tested against the remaining £188,275. The amount above that, still £21,725 as, is taxed as income. In David's case, the total taxable excess is the same either way because the combined total does not change. But in many real situations, particularly where one lump sum falls entirely within the allowance and another only partially does, the ordering choice affects which scheme ends up bearing the tax charge, and therefore which scheme needs to deduct income tax from the payment. For the pension scheme administrator and for the individual, that sequencing has real administrative and cash flow consequences. The fix closes the gap by giving the individual the same statutory right to direct the ordering for the LSA that they already had for the LSDBA. There are also two other changes in the same set of regulations that are worth understanding. The first affects anyone with overseas pension rights. From the 29th of June 2026, certain payments from overseas pension schemes are treated as RBCEs and are counted against your lump sum allowance and your lump sum and death benefit allowance. Standalone lump sums paid from certain non-UK schemes are also brought within scope. These changes apply to payments made on or after the 29th of June 2026 specifically. They do not apply retrospectively in the way that the ordering fix does. If you have pension savings in a qualifying non-UK scheme, this is relevant to how those payments interact with your remaining allowances in the UK. The second change concerns how trivial commutation is calculated. The regulations amend the rules for assessing whether the £30,000 trivial commutation limit has been reached. Under the amended rules, certain lump sums already paid to you, including short service refund lump sums, refunds of excess contributions, trivial commutation lump sums, and winding up lump sums, will no longer count towards that commutation limit. This is a technical change that removes certain refund-type payments from the calculation so that they do not eat into the headroom you have before trivial commutation becomes unavailable. There is one further piece of this that touches people who took benefits before April 2024 and are still drawing on additional pension savings now. The regulations include amendments relating to transitional tax-free amount certificates, the TTFACs. If you took pension benefits before the 6th of April 2024 under the old Lifetime Allowance regime, your remaining lump sum allowance and lump sum and death benefit allowance are reduced to reflect what you already used up. By default, HMRC's standard calculation deducts 25% of the lifetime allowance percentage you used before April 2024 from both new allowances. In some cases, particularly where you took no tax-free cash despite using lifetime allowance through a defined benefit pension, or where you took less than 25% WAR, the standard calculation overstates how much you used, leaving you with less allowance than you should have. A transitional tax-free amount certificate issued by a pension scheme replaces the standard calculation with a more accurate figure based on the actual tax-free lump sums you received. The regulations amend the rules on who must receive a copy of a TTFAC and when. Under the amended rules, if you hold a TTFAC and you subsequently join a new pension scheme, you must send a copy of the certificate to the administrator of that new scheme within 90 days of joining inside or earlier if an RBCE occurs before that 90-day window closes. This is a tightening of the information sharing obligation designed to ensure that administrators of new schemes have the information they need to calculate your available allowances correctly before they pay any tax-free lump sum. If you hold a TTFAC and have joined a new pension arrangement recently, that 90-day obligation now applies to you. So what do you actually do with all of this? There are 3 things worth considering, and none of them require urgency in the panicked sense. They require clarity. The first is to find out what your current position is relative to the lump sum allowance. If you have not yet taken any tax-free lump sums since April 2024, your full allowance is intact, £268,275 under the standard rules, or higher if you hold a valid protection. If you have taken lump sums since April 2024, each scheme that paid you a PCLS or an uncrystallized funds lump sum should have given you a statement showing how much of the allowance that event used. Add up what has been used, know what remains. That figure is the one that governs every future lump sum payment from every pension you still hold. The second is specific to anyone planning to draw benefits from more than one pension arrangement at or around the same time. If those events fall on the same day, you now have, in statute, the right to choose which RBCE is tested first for the purposes of the lump sum allowance, exactly as you already could for the LSDBA. That choice is yours. No scheme can make it for you, but you need to exercise it or the scheme will apply its own default sequencing. Talk to a financial advisor before you trigger multiple RBCEs on the same day, particularly if the combined lump sums approach or exceed your remaining allowance. The ordering decision made with the right information beforehand is far simpler than unpicking it afterwards. The third is for anyone who took pension benefits before April 2024 under the old lifetime allowance regime and has not applied for a transitional tax-free amount certificate. The standard calculation is designed to approximate what you actually took tax-free. In many cases, it is accurate enough. In some cases, defined benefit pensions where no lump sum was taken, or situations where you commuted less than the usual 25%, the standard calculation reduces your remaining allowances more than it should. HMRC provides a tool on gov.uk to help you check whether a TTFAC is likely to benefit your situation. It is worth running your numbers through that tool if you have not already before your next RBCE. Here is the thread that ties all of this together. When the lifetime allowance was abolished in April 2024, the replacement framework had gaps. Some of those gaps were technical. The legislation did not always do exactly what it was intended to do. The regulations that came into force on the 29th of June 2026 are the 4th set of consequential amendments since the abolition. They fixed the asymmetry in the ordering rules. They They bring overseas pension lump sums properly within scope. They tighten the information obligations around transitional certificates. None of this is the government changing course. It is the government completing the implementation of a change it made in 2024, working through the places where the original legislation fell short of what was intended. The ordering fix in particular is one that should have been there from day one, and for anyone who took multiple lump sums from different schemes on the same day between April 2024 and the 29th of June 2026, HMRC's position is that the retrospective effect of these regulations means the correction applies back to April 2024. The practical consequences of that retrospective application are still being worked through across the industry. If you crystallized benefits from multiple schemes on the same day in the period since April 2024, and were not able to exercise an ordering choice for the lump sum allowance, it may be worth discussing with a financial advisor whether the retrospective correction changes the tax position on any of those events. If you know someone who is approaching retirement with more than one pension, or who has already started drawing from multiple schemes and is navigating the new lump sum allowance system for the first time, send this to them. Not because they have done anything wrong, because the ordering rules that apply to their pension commencement lump sums are different today than they were last week, and that difference matters most to the people who are not aware it exists. Subscribe to this channel for plain English coverage of what is genuinely changing in UK pension tax rules, the regulations, the dates, and what they mean in practice for real retirement decisions. I will see you in the next one.